Turbo Trading with head trader Robert Knight, MBA.
This is just an update on what Chairman Powell had to say. The FMOC and Fed Powell, and now so when the market or when the minutes came out at 2, we did have an initial spike, and then our good friend Mr. Powell starts talking, and we get this huge 5-wave move down. And what I just wrote and posted in the chat room was that in bear market mode, we're not in a bear market, but the market is bearish. In a bear market mode, you generally see bounces into major events, which was the FMOC notes, and then the selling comes as people, because the markets are down, people take their profits, or they don't like what they've heard from the Fed, and today we get this huge sell-off. So the question was, it seems like the Fed chairman wanted to keep a strong market. He would not say things like inflation is slightly worse, as that is actually a qualitative, not quantitative statement, and perhaps drives some fear, and that perhaps drives some fear into the markets. Curious to your thoughts, and is the market strength something that the chair really cares about? Okay, so the quick answer to that is the Feds don't care about the market on a daily basis. That's not their job. Their job is to manage the economy as best they can through interest rates and by bond purchasing, supplying liquidity to the markets. They have a very delicate balance onto what happens and in the economy. Now, don't forget, the market is so maybe the Fed does care about the market but that's sort of after the fact. What the Fed is interested in is a steady growth in the economy, inflation just around 2%, and growth, at 4% per annum. That is a stable, growing economy. So the Fed, their main job is to try to manage the economy as best they can to meet those parameters: 2% inflation, 4% growth. And so they have several tools at their disposal that they can use, and that mostly is taking or either adding or subtracting liquidity to markets, that's the bond purchases, or interest rate levels. And right now they're at 0, so they can't really go much lower than 0. So their tool at the moment is liquidity, and they're withdrawing that liquidity because a couple of things have happened. Inflation is very strong; it's running at over 7%. There is full employment; the economy's strong. So the Feds need to put a bit of a break, need to put brakes on the market, but they don't want to raise rates too high. So they're using mostly liquidity to adjust the buying and selling of bonds, so they withdraw the liquidity, because they can't really afford to raise interest rates because they have so much debt on right now. They have 28 trillion or whatever the number is on the balance sheet in debt, that any a quarter point move up is significant, hundreds of billions of dollars in interest payments that they need to make every year then. So they try to keep the rates as low as possible, and they want to, and now the other thing though that they want to do, and they may not be saying this, but with inflation at 7%, that monetizes that debt, and so in effect it removes the debt through inflation, and thereby bringing it down, because the dollar, they're paying back the debt with inflated dollars, so it's easy. They can just print a bunch of money and pay the debt off, but they need to keep interest rates low for that. So what they're doing right now is they're withdrawing liquidity from the market. So to get back to the question, does the Fed care about the market? The Fed doesn't care about the market on a day-to-day basis, except that the market, but there's two caveats to that. One is the market is a reflection of the future value of the economy, or the future direction of the economy. The market looks 6 months ahead, 3 to 6 months forward. That's number one. But number two, if the markets collapse, that takes money, either real money or perceived money, so paper profits or actual profits from people's pocketbooks, which then affects their ability to buy, and then that weakens the economy because they're no longer buying. And it doesn't necessarily have to be actual losses or actual deterioration, but it's people's perception of where the markets are going. Markets, maybe this is a 10% pullback, and this is where they are, it's going to hold and then start to go again because the economy is very strong. But if people's perception is that the economy is tanking, then they're going to react accordingly to that. Even though the economy might not be tanking, if their perception is that it's going to tank, then they will stop buying. So the Fed, on the longer term, has a big vested interest in the markets being strong, because that's people's perception of what's happening in the world. And if the markets stay strong, then that means people have money in their pockets, and they go out and they spend and they buy, they build houses, they buy cars, they go to restaurants, they do a lot of things. That creates more employment, yada, yada, yada. So the economy is the Fed's main objective, but they always have one eye on the market because they don't want to upset the apple cart too much, because that will grow the economy. That's people's putting money into the markets or taking money out of the growing market so that they can buy things. There's an old story, and it goes something like this. There was an old gentleman, and he was standing on the corner in Midtown Manhattan, and he had a hot dog stand, and he was doing really, really well selling hot dogs. It was booming, everything was going great. Then one day his son came home, Harvard grad, and he says to his father, he's visiting, he says to his father, "Dad, don't you know that the economy is softening up, and that we're heading into a recession, and things are looking really, really bad?" And the father says, "Well, gee, my business is doing really, really well, but you're a Harvard grad, so okay, I'll take what you say." So he cuts back on his buying. He cuts back on his hours, and and so then all of a sudden fewer people are coming, and so he has to cut back more buying. His prices he has to drop. He's not selling as much, so he cuts back more hours that he's open, and pretty soon he goes out of business. And he says, "Oh, that's amazing! My son is so smart." So the point of that story is that it's people's perception of what's going on. It may not be the actual event, but the father, believing what his son said, cut back his business for no particular reason, even though he was booming, because his perception was that things were going to get bad. And sure enough, the outcome was as he determined in his own business by cutting everything back and stop selling. So that is the long answer to the question of, does the Fed care about the market? If anybody has any questions, feel free to ask.
Reach new levels of trading proficiency. Become a member at turbotrading.biz.